Let's do this, guys. Welcome. Thank you for joining me this morning, 8:30 for the morning meeting, the ARMR Report morning meeting. Lot to discuss. Let's just dive right in, reminding you all that I'm sharing with you how I run my own personal capital. I used to run a couple of hedge funds. I've been managing capital for over 30 years for individuals and for myself. So what I'm doing is I'm condensing all of that experience into the virtual hedge fund community that we're building here at the ARMR Report. And what we do is we follow these basic three essential stages of how to run capital, which is what we do at institutions and why the best institutions outperform individual investors. It's because they follow really these three simple stages. They do research and put all the information on a whiteboard. They don't use their portfolio and throw jelly against a wall, if you will. They execute using algorithms. And so we have algos here at the ARMR Report we share. And then, of course, the risk management rules to protect capital. Those are the three essential stages of running money that institutions do real well and individuals don't. And so we started this virtual hedge fund community to try to incorporate those processes into how we run money. So thank you all for joining me. You all are portfolio managers, right? So you're on the hedge fund trading desk and you're portfolio managers of your portfolio. You bring your own capital to it. And so you have to determine the type of manager you are, take the information I'm sharing with you, and adjust your portfolio based on your own risk tolerance, your own goals, and all those types of things, which is what a PM would do at a hedge fund. Okay. What is on my mind? What's on my mind? The first thing, of course, was non-farm payrolls this morning. And Joe Biden's going to be talking at 10:30. And silly me, I put into our Slack room on our trading desk that I thought maybe it's going to be a bad, employment report. And he's going to talk about it at 10:30. No. Politicians don't do that. He's going to produce a good employment report and talk about that at 10:30 and pretend that everything is great. I forget sometimes I expect people to be honest and the world doesn't work that way. So it's always, spin. There's no way Biden would be talking if the number was bad. So he's going to come out and talk about how the NFP number, which, what do we have here, is 390 versus 325 expectations. And the prior was raised up to 436 from 428. Right, non-farm private payrolls 333 versus 301. Now, anybody in the private sector knows that's probably not true, right? So we're going to see those numbers probably revised down in the next couple of months, which is kind of weird how the whole non-farm payroll number works. You get the number, then you get these huge revisions sometimes in the opposite direction. And what I can't believe is everybody still cares about the numbers. They're obviously manipulated to suit whatever the agenda is that day. So what's really going on? And this is the other thing at the top of my mind. Tesla, Amazon, Coinbase, and a number of other companies are announcing hiring freezes and are pulling recent hiring offers off the table. I just named three. Three. I just named three, right? So there's so many more than three. I got four fingers up. There's a lot of companies freezing hiring. So whatever the number is today, if you look at what's really going on in the real economy, hiring is stalling. Hiring is going to start going down. I saw the unemployment number actually tick up to 3.6 from 3.5 estimates. Prior was 3.6, so that was even. Average hourly earnings, 0.3 versus 0.4 consensus. So earnings stay flat. What's the market doing with that? Market is exactly where it was before the news came out. So it means nothing, that NFP number, nobody cares. But what I care about is a trend from a lot of corporations that they're freezing hiring or actually rescinding offers. That's stagflation. We're heading for the 1970s. Of some kind. It's not going to be exactly like the 1970s, right? If you're a student of the 1970s, if you've done your research, one of the reasons for hyperinflation, right, that was just getting out of control, is that there was a euro dollar process that allowed countries outside the US to print dollars. Okay. And they all ran with that idea and printed too many dollars. So it created something unique in the 70s. We don't have that today. We have, a whole new set of problems. It's like in Jurassic Park 2. You guys remember that? Jurassic Park 2, where the character says, "Don't worry, we're not making any of we're not making any of the mistakes we made last time." And the Jeff Goldblum character says, "No, you're not. You're making all new ones." So that's what's happening today. We're making all new problems, but it's not exactly the 1970s. So these are macro conversations I'm having with you. And usually at the ARMR Report, we stay rooted in the present and we just read and react to what we're seeing. And right now we're long the equity markets, the risk monitor's green. So I'm going to get to that in a minute. We're going to look at charts, talk about top of the whiteboard stocks that I would probably, I'm looking to add to the portfolio. But I just wanted to go over that with you, real quick. We got a payroll number that was pretty much a little bit better than expected. Biden's going to talk about it like it's great, but in the real economy, things are slowing down, and we always see that show up in these numbers, 3, 4, 5 months later, okay, or maybe 2, 3 months later. I don't know. So there's the negatives. Those are the negatives. Let's talk about some positives. China's reopening. Now I've heard I've heard a lot of wild fear that China is going to take over Taiwan. Nobody knows if that's true. And depending on who you talk to, it's definitely true or it's not going to happen. Who knows? Okay. I don't know. All I care about is they're reopening right now. COVID's, lockdowns are kind of over at the moment. Hopefully that will hold. And what does that mean for demand? First thing it makes me think are basic materials, basic commodities. So we're going to talk about that in a minute. So those are the things that are on the top of my mind right now as I enter the day. Let's root ourselves in the present and go look at the market itself, okay? And start with the S&P. All right, so the first thing I want you to notice, the thing that's most important, is that this yellow dashed line, we're looking at the S&P now, the yellow dashed line is the May 4th Fed Day hawkish comments, which is right here. Okay. The low of that day has been an area that I've been eyeballing, this whole time. I'm thinking that's major resistance. So the Fed got real hawkish and the market freaked out and sold off. So I expect that level to be the resistance. And we broke through it yesterday. I mean, that was a really bullish day, just up all day. Now, you can see here volume was light. So there's the only downside to that. There was no real volume on that move. Okay, but that's a real bullish confirmation of the risk monitor green from last week. And if I take you over to, this is the intraday day trading page, right? So these are all of our 3-minute charts on the indexes. Let me just blow this up for you. Okay, so the S&P, the NASDAQ, small caps, and the Dow. Okay. And whoops, this is May 4th Fed Day, this yellow dashed line. So every index on a 3-minute chart, just blowing up what we just looked at in the S&P, they all closed above the resistance level. Now this morning, they're going to gap down back below it. Okay. So what I said to you when the risk monitor went green last week is we need a follow through week next week. Most risk monitor greens fail in the first week of trading after the signal. So, the first 2 days, the market challenged, held, moved higher. Yesterday really kind of had a real strong day, made new highs, right? But the weekly candle is most important. So let's see what happens today. I don't care what the open is. And quite frankly, I'd rather it be down at the open than up at the open. So market's going to sell off at the open. Let's see if it finds its footing again and then starts to work its way higher by the close. That's the bullish aspect. That's what we hope happens. The opposite is the market craters all day today, and there's a huge negative weekly candle. You could be sure at the ARMR trading desk, we will be cutting positions out of the portfolio. positions will be hitting stops and we'll be going to cash. And we'll go into the weekend in a much larger cash position. So join us on the live trading desk and we'll walk you through either how we're day trading the indexes, using VIX to help hedge the portfolio, or changing the portfolio structure based on what's unfolding. Okay, so we read and react right here. That's what we do. That's all we can do because there's so much noise out there. Managing money any other way, it's just like totally unfeasible. Even if you were to guess right this time, you'll guess wrong the next time. And guessing's not an investing strategy. Buying and holding's not an investing strategy. Right? So we build our whiteboard, we use algorithms to execute, we use stop losses to defend, and then we just step back and execute the strategy and see where we end up. This could be a week where, we have a great close and the market, rips higher. Okay. And there's a weekly close on the S&P above the key Fed day. We close above this yellow line, right? And we're making our way probably towards a 200-day moving average. And we're trying to make some money on that swing trade. That's really what we're doing right now. I'm not making any other call. I'm not saying that the bear market's over. I'm not saying anything. I'm just saying, here's an entry point. Here's the stop right in here. Okay. And we're looking for expression at the very least up here where we'll start booking profits. That's the target. We run up to the 200-day and we'll start booking some profits. We'll raise our stops. That's what we're trying to do with this trade. If it breaks out and runs for reasons that no one will understand, great. We have all of our capital to work. We're making money. We booked some profits on the way up, and we'll keep growing our net worth. If the whole thing reverses and breaks down, right back to cash because we know this picture is really ugly. Okay, and so I always like to take this conversation and break it down for how would an investor use the information. And I just break it down into conservative, balanced, and aggressive portfolios. If you're conservative, you still have a lot of cash in the portfolio. You're only focusing on the indexes to limit your risk. You're trying to make some money on a swing trade. That's great. All right. Maybe you have a couple ETFs in there. Maybe you have a couple dividend stocks in the portfolio. It depends on how you want to run it. Okay. That's the structure. And so there's not much emotion about what's going on here. It runs higher, you get to make a little bit of money, comes down, okay. You'll lose a little bit, you go back to cash, no big deal, okay? If you're balanced, it's the same approach, but obviously a bigger position size, still holding some cash in the portfolio because we're in a very difficult market, right? And if you're aggressive, hey man, you've put all your capital to work, but if you're gonna be aggressive with me, you have to understand how fast we trade in a market like this. Now, the Fed was behind us. If the Fed was out there adding liquidity, buying bonds, doing all of those things they did in 2020, our stops would be a little bit wider. We'd be a little bit more willing to let things progress, okay? But in this market, where we're on a knife's edge, if you're going to call yourself an aggressive trader, you have got to follow the stops aggressively. And if you don't like that, if you say, well, I don't want to trade that much, then you're not an aggressive portfolio manager. Maybe you're balanced, which means you're going to have bigger cash positions, smaller position sizes to deal with the volatility so you don't blow up your account. Okay? But if you're going to join me on the aggressive side, then please understand you can't put a position on, have it hit the stop, and start convincing yourself why you're going to hold just this one. Because that just won't end well. You might get lucky this time around, but it won't end well over a long period of time. An aggressive trader must stay aggressive. That means if stops get hit using aggressive stops, you're out. You're taking some losses. It happens. You take them quick. Protect your capital at all costs. If this is a good market, if this market's going to go higher, it'll stay above the stops and it'll start to rip. That's what bull markets do. If it's anything other than the bull market, you don't want to be that aggressive. Okay, so keep that in mind. What we did yesterday, and we're going to see if what we did yesterday was the right thing, but we added our precious metals allocation as described to you yesterday morning. Okay, so we added a third of our position right in here. And I said to you, we're going to either add more if it comes down to make a double bottom at this uptrend line. This is Sprott physical gold now. Or we're going to finish off our position if it closes above the 200-day moving average. Okay. So on the move above the 200-day yesterday, we finished off our position. Now we did it right in front of non-farm payrolls, and I can't help that, right? I don't know what the reaction in gold and silver are going to be by the end of the day. But this is GLD, just to get another look at it. That's the close I was looking for. Now, if this ends up being a little double spike top and the whole thing implodes, I'll go back to cash, guys. I'll sell them. I don't care. I follow stops. But these assets did exactly what we were looking for. Remember that? Sprott physical silver. Okay. If it closes above that white line, I want to have my position on. I put a third of the capital to work here, increased it here. I actually had, at the end of the day, it was more than a third of the capital I put to work before, because I didn't triple my position yesterday. I doubled it, maybe a little more than doubling. I did a little more than doubling. That's all. And that was the max allocation for me. So I went from 10%, to put it in perspective, dollar amounts or percentages for you. I put on 10%. So if 100% is my portfolio, I put 10% allocation into precious metals before the move, and I doubled it to about 20 to 25%. So 20 for conservative or balanced portfolios. Conservative is probably still at 10. Balanced portfolios are around 20, and an aggressive portfolio, I'm pushing 25%. So I didn't quite get to 30, but I'm more content in the 20 to 25% area. Okay. What do we add? Don't forget, we already had Newmont Mining. So that was, we already added Newmont and Gold Corp, Barrick Gold, to our dividend portfolio. And then to our growth portfolio, we added Agnico. We added Franco-Nevada. These are our favorite names. These are the names that totally outperformed. During this rally here, these are the names that made money. All the other names that you know and love, they're small cap, mid cap, they didn't perform nearly as well as these stocks. Okay. So I'm staying with the big institutional favorites. Wheaton Precious. And then I missed Royal Gold last time. I'm not going to miss it this time. I like Royal Gold a lot. I love that setup too, right there at the 200-day. All right. Now, in order to make room for some of these names, I wanted to take down my energy exposure a little bit. Okay, so I booked a profit in energy service companies, OIH, the service sector, and XLE. XLE was really a no-brainer. This looks great. Okay, I'm just using it to fund precious metals. So I just moved from one commodity to help fund another commodity. Okay, but we own the three biggest names in XLE are in our portfolio, right? We own Shell. We own CVX, and we own Exxon. Those are all in our dividend portfolio. So I just don't feel the need for excess if I need the capital for somewhere else, and that's where I got it. So I still love the energy sector. I had an over allotment of energy. I think at one point I had like 46% of my money there. That's just way too much, but it worked. I made some money, but I just want to pare that back to something more reasonable and use that cash to fund my precious metals. Now let's go over uranium real quick, okay? Cameco, we bought it in here. We're still long Cameco. We didn't sell it out. But the other small uranium stocks got whacked the day before and tripped our stop. So we got out of UUU. I put it back on at a smaller position size so I can deal with the volatility. And UEC, I put it back on with a smaller position size so I can deal with the volatility. And instead of using the low of the day on UEC as my stop, I'm using a 50% retracement of this huge up candle. All right, the candle was on volume. It should not retrace more than 50% of this candle. Okay, so if it does, I'll follow my exit strategies and I'll be out of the trade. And I'll look to buy it again if it sets up a pennant or something. Okay. So those are some of the portfolio changes that we were executing yesterday. Let's jump to top of the whiteboard. I want to go over this with you real quick because this is a real interesting idea. And we picked up this idea from Dan Niles, whom I happen to respect. I think he's a good guy. I think he's a smart guy. This is a crazy idea. Anybody who knows me knows that I've been saying for that entire downtrend that you see right there, I've been saying avoid Chinese stocks. I don't know why anybody would invest in Chinese companies. Okay. And I've gone over and over that. And I've explained that I wouldn't do it because primarily they don't follow generally accepted accounting principles. So how can I possibly value the company? I don't know if the numbers are totally made up. I don't know anything about the companies. So how can I own them? And you won't see me buy an individual Chinese company. I can guarantee that. But Dan poses an interesting, question. And I'm going to add a little extra to it. So his thought is, some of the reasons, and I'll just read off this tweet to you because I think it was really interesting. Thank you, Segal, for posting it in our Slack room. I retweeted this on my Twitter feed for anybody who follows me on Twitter. Anyway, KWEB's down 71% from an all-time record high, okay? And it's due to three different things, three different policies. The drive to common prosperity, I don't know what that means, heavy new regulations and citywide lockdowns. 2 and 3 are nearing its end versus natural economic slowdown in tech. So what he's saying is part of the reason why the assets have been destroyed is the way the government's been behaving. And he thinks that they're making signals that they're coming to an end of that, right? And the COVID lockdowns are over at the moment. So the economy is going to start heating up again, so theoretically. And more importantly, it looks like China is really using a quantitative easing process, right? They've got problems in their real estate sector and all this stuff. And what they're doing is following U.S. Examples of liquefying the market. And we know what happens to stock markets when a central bank liquefies. Now I'm going to give you my spin on why I'm interested in the trade. It's a totally asymmetrical trade. I mean, nobody likes Chinese stocks in the mainstream media. I mean, except for Dan Niles. I mean, nobody. I mean, people will tell you China's going to invade Taiwan in a couple months. Well, that'll crush KWEB. I mean, how do they know that, right? So that's just somebody's fear-mongering and guesswork. They don't know that. But with the stocks down huge already, everybody's expecting that. So when I say an asymmetrical trade, what I mean is look at where KWEB is trading. It's making a base going back to, what is this? March. So it's making a base since March. It's making really a bottoming wedge. Let's go like this so we can see it better. Well, I'm not sure that's going to help us. I wanted to try to blow it up a little bit for us. Okay. So this is clearly making a bottoming wedge right here. Something like this. So the only reason why I'm interested in this is that there's a really cool chart pattern that's forming on this thing. It's making a bottoming wedge. It had this ending gap down, gap up, island reversal. That's just total capitulation in March. Okay. Now it's making higher lows and it just broke the downtrend and it just popped above the 50-day moving average. I could use a stop really of 2 days ago. Goes back below the 50, I'm out. So when I say asymmetrical, what I mean is very small risk to the stop. Overnight risk, I can't help, right? So if they declare war on Taiwan, I'm screwed if I own the position, right? Okay, let's all understand that. There's a lot of risk there, okay? But I'm going to make the assumption, and I make this assumption all the time when I run money. Smart money will know that's happening before the news comes out. And this stock will break down before the news comes out. It's an example I hate giving, but I'm going to give it. Airline stocks were down huge a month before 9/11. All right. People know. People always know. So if we follow price movement, we're going to find out what's happening before the news hits the market. in 99 times out of 100. Okay. So if the stops get hit, I'm out, and I would get real bearish. I would assume something's wrong. China maybe is going to go into Taiwan. Okay. But the upside's enormous if China doesn't go into Taiwan, right? If they kind of back off of that, if they add massive amounts of liquidity into their system, if, they're in the process of trying to come up with a, resolution to the gap issues and stay listed on the U.S. exchanges. I mean, nobody thinks that's going to happen right now. Everyone hates the idea. Everyone hates China. And that's what makes me interested. Now, I feel ridiculous even talking about it with you. The fact that I'm talking about it with you makes me feel ridiculous. And that's what makes me interested. Do you know what I'm saying? Because that's very often when you're buying right. When fears are at their highest, that's when you end up buying right. And the last piece to this puzzle, and I'll move on, is that this seems like a beautiful hedge for a portfolio full of energy, defense, commodity Armageddon type of stocks. Right? Let's just spitball for a minute and pretend that the world stops teetering on the edge of nuclear war and things start to get walked back. The upside is enormous in China if that actually happens, and they're adding liquidity to their markets. If we just ran money by shorting indexes in countries that were reducing liquidity and buying indexes in countries that were adding liquidity, I bet you'd have a great hedge fund. I think sometimes we overcomplicate things. So top of my whiteboard is KWEB, and I'm really considering an allocation in KWEB. I don't know if I'll get there, but I'm just sharing with you. Now, what's the other thing about China that gets to the top of my whiteboard? If China's opening up again, if there's a massive amount of liquidity injections, COVID lockdowns are over, blah, 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 then I've got to be interested in basic materials. So I have to put back on my list, the top of my list, Rio Tinto at a 9% yield. Of course, that yield changes, but Rio Tinto sold off back above the moving averages. BHP just completed a spinoff. That's why the stock was, the stock had a nice run on that. BHP. So I'm looking at, I think it was adjusted because it had a spinoff. So, BHP looks like it's, cup and handle starting to move in here, right? Maybe I'm a little bit late on that. Valley is starting to come back on. And of course, tech coming on. And let's just for good measure, copper seems to always run. And here comes Freeport-McMoRan. So you put all of those charts together right there. And you start getting a picture of what happens when China starts to reopen and consume a lot of basic materials. So it feels like a really interesting balance for my portfolio, and I wonder if I can get there. I would have to make room in the portfolio to do it. And I might be doing that. So those are the things that are at the top of my whiteboard. I believe those are all of my thoughts for you right now. If you have any questions for you, I'm happy to take them. Let me see. EMPH. So I talked about this yesterday, Aris. You might have been off the desk. I like EMPH, right? EMPH and Solar Edge, those are my two favorite names. They have the same type of chart patterns. Those are my two favorite, Solar Edge and EMPH, my two favorite solar stocks. What's holding me back right now is that it's just a wide and loose pattern. And those aren't my favorite patterns. I like tighter patterns. It's also solar is not at the top of my whiteboard when it comes to allocating assets right now. But we can discuss it. You know, I wouldn't say no to it, but there's just some things. It just doesn't ever really crack the top of my whiteboard. I'm always interested, and then I just don't put the money to work for reasons that I can't really crystallize right now in this conversation, but we can talk about it. Yeah, I know. Seriously, Brian says it must be an alternative universe watching me talk about China. It's true. It's crazy. You know, it's crazy. I understand it's crazy, but look at the bottoming wedge. And the fact that it's crazy is what makes me want to talk about it, you know. I've been right all the way down on China. Let's be honest. Okay, let me just say that. But being right all the way down isn't the entire equation. It's being right and avoiding destruction, and then it's being right and capturing upside. You know, so I have to have an open mind. If we're not going to have an open mind as investors, then you know, returns are going to suffer because you can't be nimble. You keep forcing your will on the market, and you miss wild opportunity. And so China's just fitting. It's like fitting into an interesting part of my portfolio from a hedge point of view. It's just interesting to me. I can't guarantee I'm going to do it, Brian. I don't know if I'll be able to get over my concerns, you know, but if I made investments my whole life when I was most afraid of something, and I sold investments when I was most excited about something, my returns would be dramatically better. Now, I've done well in my life, but dramatically better. Okay. And this is, I think, an example of that. And so I'm always trying to evolve as an investor. You know, I feel like as portfolio managers and investors and running a hedge fund, running a virtual hedge fund, we're like sharks in the water. You know, if we don't keep moving, we die. If you don't keep evolving your process and opening your mind, you stagnate and die. Because what ends up happening is you start forcing your will on the market. You start thinking you know better. You start turning into Cathie Wood. And then it just all comes crashing down. So, don't worry, Andrew. If I put some money in China, I've got stops. So I put some money to work. It hits a stop. I get out. It's not the end of the world. American Airlines spoke about Q2 earnings levels roughly. Okay, I believe Delta increased cost of travel being absorbed by customers. Well, that's interesting. Look at jets. Global ETF on jets. There's nothing about that chart that looks interesting to me, but you know, we can keep it on the radar. I can't imagine. I mean, that's looking behind us, though. I'll be honest with you, iMagic. I think that if fuel costs continue to skyrocket, I don't think travelers will do that for much longer. I think that travelers were, you know, stir crazy, being stuck at home for a couple of years, and the window was opened, and they're spending some money and going out. I'm not sure that's going to last if rates keep going up. Price of energy keeps skyrocketing. Yeah, Brian says you wait for your pitch and you hit where it's pitched. That's right. Yeah, that's right. Any other thoughts, any other questions? If not, I'm going to skip over to set up our live trading desk. All right. Just looking real quick. Anything I got here? Just want to share with you. All right. That looks like it's it for. Oh, wait, there's a comment. Let me see what it is. Will KWeb get hit as hard if this monitor goes red again? I don't know. That's a good question. I don't know. I mean, our risk monitor going red is about our Fed reducing liquidity and our index is going down. In China, their Fed, their central bank, is adding liquidity. So theoretically, it shouldn't have anything to do with that. But I don't know. I don't know. I don't know the answer to that. And so at the end of the day, Dennis, if I make it an allocation, first of all, feel free to not follow me down that rabbit hole. Everybody, okay? As always, I'm just sharing with you what I do with my own capital. You don't like it, you don't have to do it, right? But the way I look at it is I'm going to put some capital to work. I'm going to have a stop. I'm going to see if my theory is right, and the stop is going to protect me from myself. With the understanding, guys, okay, that if war breaks out in China overnight, I'm screwed in that position. Okay, let's make sure we all get that. So there's risk in that. But that's true about any investment we make. You go buy a biotech stock and they announce that their drug doesn't get approved, it's down 50% the next morning. So whether it's biotech risk, China governmental risk, or whatever, there's always overnight risk of implosion. So I just take that fear and I put it over here and I say, I can't run money worried about that. I have to make logical decisions. I use chart patterns. I use all the powers that I can put together when it comes to fundamental research. I use execution algorithms, which are giving me a buy signal on KWeb right here. And I say, okay, I'll put some money to work. That's all. That's all we can do. You know, you got to simplify the process or you get stuck in inertia. Right. And I just saw Brian's message in Slack, and he just said what I basically just said. He just put in the Slack room that in the middle of the night, China can do something that'll wreck the stock. Absolutely agree. So if that concerns you, don't put money to work. If you still want to put money to work and you want to somehow manage that risk, smaller position sizes. And we're not talking about putting half our portfolio in KWeb. You know, so something appropriate. And if you don't like the idea, don't put it in the portfolio. Okay. Anyway, those are my thoughts for today. Thanks for joining me. I appreciate the time you guys spend helping me order my thoughts so that I can be the best portfolio manager I can be when the bell rings. I'll see you guys. I'll see you guys on the flip side. Have a great day of trading.